Hi everyone, may as well get started. My name is Michael Frazis. I'm portfolio manager at Frazis Capital Partners. I thought today I'd just give a quick rundown of what we do and then go through some tech valuations and where things are at the moment, how they've traded in the past and how things will go in the future. So I'm going to try and share screen now. So we will share screen two. Let's start this. So we basically invest in technology in the life sciences, and we invest in companies with three characteristics: intense customer love, explosive growth, and market leadership. Now, in a weird way, like investing is kind of somewhat predicting the future in the sense that your returns are going to depend on what happens, in the years ahead. So one of the reasons I like customer love so much is one of the best guides to what people are going to buy next year is what they love so much this year. And we use growth as a way to kind of measure that traction. Somebody's doing something exciting and interesting. You'd expect a lot more people to be doing it today than they were last year. And similarly, you'd expect a lot more people to be using it next year than they are today. So that's where those two things come from. If you think about it, these kinds of characteristics really explain a lot of what would otherwise look like very strange behavior in markets. These three characteristics match companies like Netflix, early days Amazon, and a few that I will show you now. Now, the striking thing about companies that fit these characteristics is that they don't just, generate good returns or positive returns, but they're often, the best performing stocks in the world. This is Afterpay. You can see that Pinduoduo managed to capture, over 10% of the Chinese market in a few years. People love the app. Before they're generating significant revenue, people are spending significant more time on Pinduoduo than many of their competitors. This is an example from retail. So you can see the US retail index has gone nowhere in the last few years, but leading e-commerce providers have generated outstanding returns. Again, these aren't just good returns, they're outstanding. Tesla is another example that we are all very familiar with. And I'll actually go through that one in a bit more detail. Basically, what we're trying to do is we're trying to create a portfolio entirely of these kinds of companies. These are some examples of the companies that we currently own, many of which we've owned for a year or much longer. Another way of looking at what we do is we kind of divide it into thematics. So these are the core thematics we're invested across right now. This is the Tesla stock price. This has been one of the top performers around the world. If you're short this thing the whole way, you probably significantly underperformed. And if you're long it, you probably outperformed. There's a huge jump. That's 7 times in a few years. The striking thing about Tesla is that the fundamental chart looks just as good, if not more impressive. In fact, in many ways, it's more impressive. There's plenty of things that spike. There's not many companies that go from selling 2,000 cars up a quarter up to over 100,000. You can see that on an annual chart. It's also quite impressive. The 2,600 in 2012, 367,000 last year, and probably a lot more next year. And so when you think about it, Tesla was always controversial. There are a lot of people trying to short this thing. There's still a lot of people trying to short this thing. Tesla Cube, the short sellers had their own kind of, nickname for what they're trying to do. And like a huge amount of ink was spilt, discussing how overvalued it was and how it was a fraud and all kinds of things would happen. This is what they're shorting. They're shorting a company that went from going from 2,000 cars a year to 367,000. This is the rare bit. This is the hard bit. There's quite a few companies in the world that do this, maybe, less than 100, more than 20, less than 100, that kind of range. We're trying to create a portfolio of just these kinds of companies. In effect, we're trying to ignore the price movements as much as possible and really make sure we capture these kinds of uplifts. I think that was about a 20 times increase in share price over this period. And sales are up, obviously, probably 20, 30 times or more, depending on which time frame you use. The other interesting thing about Tesla is it actually made EBITDA. People seem to be surprised by this. You could get this for about 20 times EBITDA last year, under 20 times EBITDA. So the way you read these charts is the light blue line that's kind of jaggedy. That is the actual share price. That is the revenue. So if you see it around here, you can see this is the EBITDA. That's this line. And you can see that the EBITDA multiple just spiked and again came right back down only a few months ago. So this is not expensive. You could use traditional metrics to see what it was like last year. And this is kind of their actual numbers. So you can see it went from 500 million EBITDA to close to 5 billion by end of this year. So that's kind of the jump that you want. This is the thing you want to own. You don't want to be short this thing. Yes, the multiple has jumped around and now we're at the extended side of it, but this is the real jump. This is what we're trying to capture. An interesting thing is this is a stock that everybody knew. It wasn't some small cap that you had to discover and do hundreds of meetings with management and, scale the world for. This was in front of everybody's eyes the entire time. And that is very interesting. Now, most of the car industry is deeply, deeply depressed. These things are trading at sub 1x sales and have been some of the worst long-term performers of the last 20, 30 years. But there's another car company people love, which is Ferrari. If you look at Ferrari kind of has a similar EV sales here. It's always traded a premium. It's always generated profit. So if you look at these numbers, say 9x sales, it's roughly in line with Ferrari. I've always just found that an interesting comparison. I don't think you should be comparing Tesla to Ford. I think you should be comparing it to a company that actually, can generate significant margins and people actually want to buy it and has that intense customer love and support. And the other interesting thing is customer love actually is a fundamental thing. It's not just something we're saying. There was a huge depression in auto sales. Global vehicle deliveries were down significantly in the first half of 2020. And it looked a lot worse, in the first quarter of this year. But you can see throughout this period, Tesla's grown. So that customer love actually translated into significant outperformance against its peers. So when you think about why is Tesla on a historic sales basis valued so much more than the others, this is the kind of chart that shows you why that is justified. And this idea isn't new. My guess is, if you went back 100 years and bought Ford when it was making these kinds of cars, I'm sure you've got similar stock price appreciation. This is another way of looking at what we're trying to do. So this is Shopify. Again, company everybody knew, many had an opinion on. A couple of things. Firstly, we're trying to capture this light blue growth line. It's gone from a few hundred million to a couple of revenue to a couple of billion. This is really what we're trying to capture. But what happened if you got this right? What happened if you overpaid in 2015 for Shopify? You've done extraordinarily well, because ultimately the longer you go, the more important this part of the curve is, the light blue line. Now, if you think about it, day to day, if a company's growing at even 100% a year, it's only 0.2, 0.3% bigger each day. So the price movement, of any particular day the growth rate is irrelevant. You could say the same over a week, a month, over a quarter, you're starting to get 10, 20, 30% growth in some of our companies. Over a year, obviously these companies are growing very fast, but really over 3, 4, 5 years, that's when you get to the point where, in many ways, that's where you get these kinds of charts, because the growth has just been so significant. It doesn't really matter what you paid for this in 2015. The trick was, did you buy it and did you hold it? Did you trim it every time it got expensive? Did you trim it in this 2017 kind of stage? If you did that, you'd have missed the meat of the move. What if you overpaid for Afterpay in 2017? Everybody knows this story. You've done pretty well. And we held this throughout this period. So there's some hair-raising moments. But in general, the winners were the people that held. The people that tried to sell at the top. Maybe they saved a 20% drawdown, but the fundamental growth was just so strong that every time the market rallied, it took new highs, significant new highs. Let's have a look at where we are now. So we're kind of top of range. So my view is obviously this comes down significantly, but I also believe that the light blue line, that revenue line, is going to significantly increase. In fact, that's what's going on right now. So in the latest update, they're growing at over 100%, significantly over 100%. And this is what we're trying to capture across the portfolio, that growth, and not just over a year. We want to capture that over 2 years, where it might be 3 to 4 times, over 3 years, where it's much more. Another example is Alteryx. Again, the longer you held this, the better. But you can see that if you held this at 30 times sales, you did actually get a fair bit of volatility. But ultimately, you still made money over a period where markets did very little, and many markets are still negative. But again, we're talking about tech valuations here. There's no way around it. We're kind of at the top of this range. So if I had to guess what happened, by the end of this year, I'd expect this to come down a bit. Now, the multiples can contract in 2 ways. They can either sales can increase, and that can drop the multiple, or the stock price can fall. There'll probably be some kind of combination. So 20% fall over 6 months and a 20 to 30% increase in sales, would drop this basically to the bottom of its trading range. Once you get to that bottom of that trading range, then your return is basically the growth. If you keep EV sales constant. And this is a company that was growing at 65% a year that accelerated to 75 at the beginning of this year, only to be sidelined somewhat by the crisis. I mean, these people sell quite expensive seats, entry level, say $8,000. So this is the kind of spending that companies will pull back on. You won't cut your zero monthly $30 accounting expense, but you might delay adding a few more seats to Alteryx, their designer product or the server product. But I actually expect that pent-up demand to come back, and in fact, this company to continue the trend that we're on. Now, this is a company. This is a chart of Twilio. So you can see again, this had a typical, 2018 to mid 2019, huge run up in the share price. Then went sideways. Now it looks like this chart looks great. This looks to be something you wish you'd own. This is actually a pretty long period. And we held this throughout that period from mid 2019 to today. So that was a long period where the share price was going down. And in many ways, you kind of think, wait, we've got this wrong. Is something up here? But then when you least expect it, and genuinely least expect it, the stock went from about $80 to 250. Effectively tripled in a few short months, right when it looked like, perhaps we'd gotten it wrong. And if anything, if there is kind of a compression in multiples, this is what it'll look like. It'll look like 3 to 6 months of, a little bit down, sideways movement. But then things will become very cheap again. The growth will have come through the entire time. And then you get these sharp accelerations in the share price out of nowhere. And you can see here, these are the fundamentals of Twilio. So it's gone from 400 million. It's not super high margin, this one, but it's gone to, 1.5. It's basically 4x over the period of this to the end of 2020. And again, that's what we're trying to capture. We're trying to capture that 4x. And that's where you get these kinds of movements, from $30, $40 to 250 plus. Like that's serious wealth creation. And our portfolio is entirely based on things like that. I talk about valuation sometimes. This is roughly how we do it systematically across the portfolio. So we'll take an average 5-year growth rate. This is a company called Elastic. It's currently growing at 55%. We'll put that on the top. We'll then leave a second variable, the exit multiple. Put that on the left side. This growth rate is roughly net of share issuance. So some companies issue quite a lot of stock every year, so 5% or more. You've got to subtract that. Here we're assuming this is an average as well. So if it ends up at 25 at the end of 5 years, 25% year on year, it's probably going to average 30, 40, somewhere around that range. Similarly, the multiple is about 13.5, 14. But we expect this to come down. We're certainly assuming in our own kind of return calculations, this comes down to 8, 10, 12. You can see around 40%, you're still tripling over 5 years. And the reason tripling is interesting is if you triple over 5 years, it's 25% a year. And that's definitely sufficient return, I believe, for the risk that we're taking, particularly given how dominant these companies are and the fact they carry net cash. This is a company called CrowdStrike. So we're slowly adding to this. We broadly missed the security story, I'd say. But now seems like a decent time. The way we'll trade something that's at the top of its range like this is take a very small position and hope that we get a chance, or assume that we get a chance to increase it significantly with time. This also shows an interesting story of what happens to things at 30, 40 times sales, because that's a pretty good guide of what's going to happen to some of these companies that are trading there today. If you bought an IPO, there was a sharp rally, went up to $90, 40 times sales, which everybody would agree is excessive, I believe. And then it contracted from 40 down to 15. And so that was a huge contraction. This is say late 2019. It lost about half of its value. So the reason it lose more than half is because that blue line kept increasing. So the sales multiple contracted because there was growth and also because the share price went down. Needless to say, if you bought it at $40 and it's trading $100 now shortly after, you'd be quite happy. But now we're at roughly, mid-20s for historic sales. This is a company that's growing at 90% plus. So I believe this is one of those companies where, kind of like Shopify, you're off the top of the range. You're kind of not getting it at some crazy cheap price, but but who's one to take a position? Because the fundamental growth is just so strong. It's gone from 120 million revenue to 480 million revenue in basically 2 years. Be close to double that next year. And given the tailwinds and security and the fact that everybody likes CrowdStrike, there's a good chance that, this is one of those stories where you look back in 3 years and you think, wow, I wish I didn't even worry about multiple. I just wish I bought it and held it and didn't trade around. And that's basically how we're going to play this current environment. We're not going to try and trade around. If something gets to 30, 40, 50 times sales, we will reduce it. But in general, with things like these, I think you're better off holding. So what are the takeaways? We're really trying to capture the long-term growth of these companies. We're trying to capture these light blue lines, this growth. It's important to remember these are software companies. So many of these, what we've been talking about, are software companies. It's very high margin. This revenue translates pretty well into gross profits. And then we expect, or I certainly expect, these companies to invest all their available cash in securing the next bit of growth. Another thing you'll notice about these high quality companies that have this customer love, is that estimates are constantly being upgraded. So this particular chart shows the kind of projection of sales for the next 12 months. It basically averages it out so that, it's a steady line instead of those quarterly jumps that you saw in the previous ones. But even this chart, you can see the jumps. And these jumps are when analysts are upgrading their forecasts. So you see, not only is this growing at a very fast rate, the slope is very steep, but there's also these like jumps where the company significantly outperforms to the upside. And this is broadly what we do. So if you do put a gun to my head and ask me what I think will happen, I think multiples will contract by 20, 30%. Our portfolio growth rate's about 60 across the board. So that's about 6 months of growth. So that could happen. And we could still be flat by the end of the year. But if that did happen, then we would effectively expect to compound at the company's growth rates from there, which would be well in excess of the market. And there's another example of our slides. So I might stop sharing the screen there. We have got some stuff. Let me see if there's any questions. Oh, there's no questions. In that case, I might wrap things up. So I'm Michael Frazis. If you want to find out more about what we do, you can go to www.fraziscapitalpartners.com. And thanks so much for signing in and having listened.